My name is Gary Smith. I'm a serial entrepreneur in the tech space, and I've raised over £50 million in venture capital for my own businesses. I also floated the first company in the SaaS space a few years ago. So you spent the last 9 months trying to raise your next round of venture capital, and it's been really tough. Investors have said no more than yes, but now all of a sudden, in your inbox, they've given you an offer and you can celebrate. You go to the pub, you tell your mum, your dad, you think, now I'm rich, I'm a millionaire. But wait, this may just be fool's gold. That valuation they put in the term sheet, it may look great, but you have to look at the small print. You see, the offer you've got, that term sheet as it's called, has lots of small print in it, and you need to make sure you really understand it before you sign anything. So there's 7 lessons I've learned about negotiating term sheets. But first, let's discuss what a term sheet is. It's a 2 to 4 page document you'll receive from the investor. It's non-binding. It'll have an outline of the whole offer from the investor, and it's the thing you negotiate first in preparation for going on to a full investor agreement. Lesson number 1, liquidation preferences. Liquidation preferences set out who gets paid and how much they get paid and when they get paid if there is a sale of your business. So why do investors want liquidation preferences? Let's go through 3 scenarios of the probable outcomes of your business. Number 1, you'll go bust one day. And we don't look forward to these things, but reality is that most startups actually fail. And in that situation, there's no proceeds of the sale. The liquidation preferences don't come into play because you're not going to get any money out of it, and nor will the investor. Number 2, everything goes fantastic, and you become a unicorn, and there's a lot of money involved. And when you sell the business, you'll make lots of money, and so will the investor. And in that situation, the liquidation preferences once again don't kick in because there's no downside protection that's needed. The third scenario is where it's probably the most normal, where things go okay. They've not been too bad, not been too great. You do get an offer of someone to buy your business, but the offer isn't really fantastic. Well, it may not be fantastic for the investor. It might be great for you. You might become quite rich out of it. But the investor is seeing this as being not the outcome they really wanted. So this is when the liquidation preference comes into play. There are lots of different types of liquidation preference, but I'm going to talk about the 2 main types: non-participating liquidation preferences and participating liquidation preferences. With non-participating liquidation preferences, these are the most founder-friendly version of the clause. Non-participating preferences are in the situation where you've sold the business and the investor has this liquidation preference as a backstop. It's a way to protect them, to make sure they get at least the money that they originally invested back first. And they get their money back first before anyone else gets any of the money. Now, there's a little twist in this, which is that often in the term sheet, there will be a multiple of the original amount that they invested. So rather than just 1 times the amount they invested, it could be 1.5 times or 2 times or more. So in this example, let's assume that the investor invested £5 million as a Series A round in your business, and for that they got a 30% stake. There's a preference clause in there. It's a non-participating preference, and it's a multiple of 1.5 times the amount they originally invested. And you had an offer for your business, and someone offered you £10 million to buy the business. So let's go through the numbers. The investor is going to get 1.5 times the amount they originally invested, so 1.5 times £5 million, and that's £7.5 million. So they'll get £7.5 million, and you and the rest of the shareholders will have to share out what's left. So that calculation is £10 million less £7.5 million for the investor. That leaves £2.5 million to share between you and the rest of the shareholders in the business. Now, participating preference shares, they're very similar with an extra little bit. So, same example as last time. The investor put in £5 million. For that, they got 30% stake in your business. There's an offer of £10 million from a potential acquirer. So let's go through the numbers. the investor gets 1.5 times the amount they originally invested. So that's 1.5 times 5, which is 7.5 million. Plus, this time, they'll get 30% of the amount that's left. 30% of 2.5 million is £750,000. So in this situation, the investor gets a total of £7.5 million plus £750,000. So you get £10 million less the £8.25 million that the investor got, leaving £1.75 million between you and all the other shareholders. Lesson number 2, reverse vesting. So you've been running this business for a number of years and your shares are your shares. Well, not anymore. Think again. The reverse vesting clause is a protection for the investor to make sure that you have a disincentive to leave the business. So the investor wants to make sure that you have a disincentive to leave the business. And so typically the reverse vesting clause will be from a period, let's say between 2 and 4 years from the point of investment. What this does is to make sure that if you leave the business within that period, you'll have to give back some of the shares you think you already own. So let's go through an example. So in this example, let's say that the reverse vesting period is 4 years and that 2 years into running the business post-investment, you decide you want to go and live on a beach. You've had enough. You don't want to be involved in the business anymore. In that situation, because you've worked through half of the 4-year period, you'll have to give back half of all the shares that you thought you owned before the investment period came in. Lesson number 3, the good leaver, bad leaver clauses. You get this wrong and you could lose everything. These set out how you are treated if you leave the business. Good leaver is you left and it wasn't your fault. A good example of this would be you died or you got very ill. You see, in those situations, it wasn't your fault, probably. And so what will happen is that you will be treated fairly, at least your family will be. The shares that you've earned up until that point, and maybe even the vesting that going forward into the future, you will still get the benefit of it. Bad leaver is where it is your fault. You've just left the business because you're bored or you've been fired because of gross misconduct. You're a bad person. So in that situation, what's happened is that you won't benefit from your shares. You'll have to give back many of your shares, maybe all of them. What you need to look out for, though, is a twist of this clause where the definition of bad leaver also includes a situation where the investor decides that you just need to be replaced. And in this situation, you might be forced to leave and you may get nothing out of your shares. Lesson number 4, anti-dilution ratchet. This protects the investor if there's a down round in the future. So you're going into your next round of investment. The existing investors you've got have got an anti-dilution ratchet clause put in their contract. It means that should things have not gone so well for you and you now need to go and raise more funding for your business, but the valuation is lower than the valuation from your previous investment, that's a down round. And in this situation, the existing investor with the anti-dilution ratchet won't have their shares diluted by this future down round. You will, though, and all the other investors around you will have done. So be careful. Lesson number 5, drag and tag. This clause defines what happens if you get an offer from someone who wants to buy your business. And it sets out who's in control of whether that offer is accepted or not accepted. Typically, this clause allows the investor to have the power to block the sale of the business or to force the sale of the business. So let's go through an example. You get an offer for the business and let's say it's £100 million and you're pretty happy with this, and so are the rest of your founders. But the investor's not so much. So the investor in this situation would be able to block the sale of the business until the valuation is significantly higher that keeps them happy. The other scenario is where you get an offer for the business that you're not happy with. Say someone comes in and offers you £5 million and the investor at this point is just trying to get some money back out of the business. They don't think the business is going to go any further. They want the sale of the business to go through and so they can force the sale of the business even if you don't want it to go through. Lesson number 6, your board of directors. In the term sheet, it'll have some definition around who's on your board of directors and how many people. So typically the investor will want to put in someone of their team on your board of directors, maybe 2. The trick here is to make sure that there's a power balance. You don't want a situation where the investor has more board seats than your team. And so typically there might be, let's say, 2 investor board seats and 2 from your team coming in. You may also be required to hire an external chairperson. You just have to be careful that when it comes to voting, that this chairperson isn't always going to vote in favor of the investor's requirements and not yours. So there were the 6 lessons I've learned about term sheets. The question really is how do you get a better offer than that? How do you make sure that some of the terms that I've mentioned earlier on are more in your favor? The key is to get multiple offers. This goes back to right at the beginning of your campaign to raise venture capital. Don't just accept one offer from one VC if you can. Get multiple investors interested in you at the same time. You can then play one off against the other and make sure that you drive through the terms that are more in your favor. Oh, I nearly forgot. There's lesson number 7. Lesson number 7 is get a good lawyer. I'm not a lawyer. You're probably not a lawyer either. Yes, lawyers do cost money, but I can tell you something. If you get this wrong, it'll cost you a hell of a lot more than the cost of a lawyer. I hope that these 7 lessons have been helpful, and on that note, I'll see you in my next video.